Hey everyone, and welcome back to the channel where we demystify the complex world of finance, one stock at a time. Today, we're diving deep into a specific company that has landed squarely on our hard-to-borrow screener, the Growhub Limited, ticker TGHL. We're going to break down exactly why this stock is generating so much chatter in the short interest community, what makes it hard to borrow right now, and what that could mean for its future price action. Stick around, because this one is fascinating. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Let's get acquainted with the Growhub Limited, or TGHL. This company operates in the technology/software infrastructure sector with a current market capitalization hovering around $14.06 million. TGHL serves as an investment holding company, but its core operations involve providing product traceability, cutting-edge data analytics, and product trading facilitation solutions both in Singapore and internationally. Their traceability solution, for example, helps organizations track products from raw materials all the way to the final consumer. Now, looking at recent price action for TGHL, it's been a turbulent ride. Today alone, the stock is down a significant 21.36%. Over the last 5 trading days, we've seen a decline of 29.8%, and the last 30 days show a drop of 6.77%. Chart highlighting these declines volume-wise, today's activity sits at 1,134,700 shares, which is quite low compared to its 30-day average volume of 10,121,653 shares, giving it a relative volume of just 0.1x. This suggests that despite the price movement, current interest might be subdued compared to its usual activity. What is cost to borrow and why it matters? So, what exactly is cost to borrow, and why is it such a critical indicator when we're looking for potential short squeeze candidates? Simply put, the cost to borrow, or CTB, is an annualized fee that short sellers have to pay to borrow shares of a stock. Think of it like an interest rate you'd pay on a loan. When you short a stock, you're borrowing shares from someone else, selling them, and hoping to buy them back later at a lower price to return them. That privilege of borrowing isn't free. The higher the demand to short a stock, or the fewer shares available to borrow, the higher this fee can become. When you see a CTB fee exceeding 100% annually, it means holding that short position for a full year would cost you more than the entire value of the shares you borrowed, a massive expense. This rise in cost can put immense pressure on short sellers, making them think twice about holding their positions. Why this stock is hard to borrow right now. This brings us directly to the Growhub Limited TGHL and why it caught our attention. TGHL's annualized cost to borrow fee is currently sitting at an eye-watering 773.1%. Highlight this number boldly, this isn't just high, it's extreme. What's even more compelling is the momentum behind this fee. It has surged by 259 percentage points over just the last 5 trading days. This kind of rapid increase signals a significant shift in market dynamics. To compound the situation, there are only about 100,000 shares currently available to borrow for TGHL. Now consider this against the company's estimated float of 12.7 million shares. That means the pool of shares available for shorting is incredibly tiny relative to the total shares outstanding that are freely traded. This combination of an extremely high and rapidly accelerating cost to borrow, coupled with a severely shrinking supply of available shares, is precisely what makes TGHL a prime example of a hard-to-borrow stock right now. Squeeze mechanics explained. So, what happens when a stock becomes hard to borrow like TGHL? This is where the short squeeze mechanics come into play. A short squeeze occurs when the price of a stock rapidly increases, forcing short sellers to buy back shares to limit their losses or to meet margin calls. When short sellers are compelled to cover their positions, they become buyers, which in turn drives the price up further, creating a self-fulfilling cycle. The shrinking supply of borrowable shares for TGHL, currently at just 100,000, means that if a buying frenzy were to start, it would be incredibly difficult and expensive for new short sellers to enter, and for existing ones to cover without significantly impacting the price. Our internal composite squeeze score for TGHL, which takes into account CTB, borrow supply, float, and price momentum, currently stands at 56.8 out of 100, indicating a moderate but notable squeeze potential. However, it's crucial to remember that a high cost to borrow does not guarantee a squeeze. Sometimes, short sellers have strong conviction, especially given TGHL's recent price drops, and they are willing to pay those high fees because they believe the stock will fall even further. Dilution risk check. One critical factor that can make or break a short squeeze thesis is dilution risk. Dilution happens when a company issues new shares, increasing the total number of shares outstanding. This influx of new shares can counteract any buying pressure from short covers, as it adds more supply to the market and typically reduces the value of existing shares. A short squeeze thrives on supply scarcity, so dilution can severely undermine or even negate a squeeze. For the Grow Hub Limited, our checks show positive news on this front. We found no recent dilutive SEC filings such as SMINS1s, SMINS3s, or 424 BAS in the last 90 days. Furthermore, there have been no recent reverse splits for TGHL in our look-back window. This lack of recent dilution helps maintain the scarcity of shares, which is a favorable condition for a potential squeeze scenario. Before we continue, let's quickly reiterate our disclaimer. Important disclaimer: this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. For TGHL, if you're monitoring the situation, here's what to keep an eye on. First, continue to watch the cost to borrow fee and its momentum. Will the 773.1% CTB continue to rise, and will its momentum stay positive? Second, observe the shares available to borrow. If that 100,000 number shrinks further, it intensifies the pressure. Third, watch for a significant increase in trading volume, especially if it coincides with a turnaround in price action. Remember, TGHL's current relative volume is only 0.1x its average. A sudden surge in buying interest or positive news related to the Grow Hub Limited's traceability solutions or data analytics could be the spark. A reversal from its current downtrend -21.36% today would be a key indicator. So, the Grow Hub Limited TGHL presents a fascinating case study in the world of hard-to-borrow stocks. With an incredibly high and rapidly increasing cost to borrow at 773.1% annualized, a tiny pool of just 100,000 shares available to borrow, and no immediate dilution risk, it clearly fits the profile of a stock with significant short interest dynamics. However, we also must acknowledge its recent negative price performance and subdued volume. This situation underscores the balance between potential squeeze catalysts and the strong conviction of current short sellers. As always, this analysis is purely for educational purposes. Do your own thorough research. If you found this breakdown of TGHL insightful, please hit that like button, subscribe for more in-depth stock analysis, and let us know in the comments what other stocks you'd like us to cover. We love hearing from you.